Analysis: Japanese investors are leaving the reflation trade to foreigners. September 3, 2025. Japanese financial markets are undergoing a long-awaited reflation trade. There's just one missing factor: the Japanese investor. Foreign buyers have been in the driving seat of a rally that has driven Tokyo shares to record highs last month and coincided with an appreciation of the yen. They have also been major sellers of Japanese government debt, causing yields on 30-year bond tests to reach all-time peaks. Global investors have been a major driver of the rise in Japanese stocks, said Nicholas Smith, a strategist at CLSA in Tokyo. There is little sign of domestic investors chasing after a rally in the Topix from lows reached in April, he said, which has pushed the index up 34.2%. As supportive government policies and corporate reforms help Japan to ignite economic growth after almost 3 decades of lackluster activity, the Bank of Japan raised interest rates this year for the first time since before the 2008 global financial crisis and has sold down its vast holdings of government bonds. That has stoked an asset rotation from bonds into equities, boosting a beat-up industrials at the expense of flashier growth stocks while favoring shorter-dated bonds to the longer-dated end of the yield curve. Some analysts believe the rally in stocks could have further to run if Japanese retail investors resume buying, after pulling out some $23 billion so far this year. Retail sentiment is finally back in the positive since last week after hitting an extremely bearish level, analysts from Bernstein said in a research report. Attributing retail investors' caution to uncertainty over how U.S. tariffs would affect Japan's economy and market volatility, they said the combination of a recovery in earnings, strong foreign investor confidence and return of retail flow looks quite supportive for markets. Foreign flows into equities this year are the strongest of the past decade, and on track to mark the highest since the Abenomics-inspired influx of 2013. Foreigners aren't the only entities buying; those corporates, through share buybacks, were even larger, said CLSA's Smith. That's very exciting because corporates are awash with cash and could afford to buy a whole lot more. Despite the outsized moves in stocks and bonds, the yen has proven relatively stable, remaining stubbornly within a 140 to 160 trading range for the past 2 years rather than strengthening from the prospects of a stronger growth, or from a rush of investor fund flows allured by higher bond yields or equity returns. The big story is the lack of repatriation flows, said Brad Setzer of the Council on Foreign Relations. Setzer attributes the absence to Japanese institutional portfolios that invested heavily in U.S. Treasury markets prior to COVID-19 are now being effectively underwater after the Fed's increases in interest rates. Put simply, Japanese capital is staying overseas rather than coming home to chase the gains. Analysts and traders are watching closely whether that will change as the Japanese markets spring into action. By Reuters, story by Gregor Stewart Hunter, September 3, 2025.